Good morning. You can hear me, right? Thank you. Uh, Let me share my slides also. Now, today, what we have actually now before the new year, we were discussing, I think, basically the last part of our materials because before the exams and the revisions, we wanted to finish our theory part, theory discussion. But I think we were not able to complete it because there are some pending areas. And after the new year, I plan to start this discussion, but then again, it got delayed. Now the situation is much different than what we had earlier. Now again, we are basically, I think, day by day, we are getting. Our movements are getting limited. But I think I thought this would be a best time that we can finish our discussion. So you have the slides actually what I'm going to discuss today. Uh, in the previous session, I shared you some slides on the financial instruments. So today what we are doing is basically finishing that discussion on financial instruments, and there will be only one more session. I want to look at the or discuss the financial market stability, financial system stability in a brief manner because there are some questions related to that area in your exam paper. So I just want to touch on that aspect as well because then you will be basically well prepared for the exam. And I'm planning to share some additional notes also, especially on the payment systems, because we had a brief discussion on payment systems. Then I remember I promised I will give you some more details on some of the payment instruments and mechanisms. So I thought of sharing a handout on that, a detailed handout. You can refer to that handout and then you'll be able to get some idea additional view or knowledge on the payment systems. That is the plan. So today and by hopefully next week we will be done with our coverage of the course, syllabus of the course. Okay. uh, Before I move to the discussion, does anyone having any questions? Since we are meeting after some time, I think closer to 1 month. Do you have anything to be clarified from me, or can we straight away move to the discussion? Can we start the discussion? I hope you can hear me. When will the exams held? I think as we were earlier informed, it will be in June. Uh, so in May and I think early June there will be revision classes. So plan was to have the exams in June. I think that plan has not been changed up to now. But I hope you will get some information from the IBSL directly. I think IBSL is also here. Probably, Kavindra, is there any change for the exam plan?
So sometimes, but there's no any notification for that, sir.
Okay, up to now there is no notification. Okay,
Yes.
thank you, Kavindra.
Okay, sir.
Thank you. So I think hopefully very soon IBSL will give you some notification on the exam. Okay, whether it is online, physical. I think the revision classes were planned to have physically, but I don't know now what will happen. Uh, uh, We'll see. We'll see.
So exam
Yes.
applications are in the website.
Exam applications are in the website. Yes.
Yes.
Is it in July? It says July.
Yes, July.
July. Okay.
Yes.
Right. Thank you. So I think you got some clarification from the IBSL. Exam applications are on the website and it will be in July. So you have some time. Okay. So let's get ready. That is our part that we will complete before the exam. So I remember I discussed or stopped somewhere here. We were talking about the securities market, government securities market, especially the bond market, government bond market, and we looked at the bill and bond market in a detailed manner. We compared bills and bonds, and then we looked at some variants of bonds that are issued by uh, governments. So we looked at international sovereign bonds. I think I used the word these international sovereign bonds. Sometimes we call them as Euro bonds, right? I remember I mentioned this name. Euro bonds also it's a different name you to use for these ISBs or sovereign bonds. And then we looked at panda bonds, samurai bonds, sukuk bonds, and also in modern context we talk about green bonds. Green bonds, sometimes they call it as climate bonds, right? Climate related finances are uh, mobilized using these green bonds. We'll move from that point onwards. Today, uh, sorry, uh, let's look at some of the, as a starting point, some of the uh, calculations, very simple calculations that we find in our exam paper. Especially in the exam paper, we have this first question where we have 10 subparts. So in these 10 subparts, sub questions, there are a couple of questions that you need to do some calculations. So in most of the past papers, we see this calculation on the bond yield. Bond yield means what is the earning, percentage of earning that you get out of a bond. Sometimes you call it bond yield equivalent, BYE. In finance books, you will call it BYE, bond yield equivalent. But simply, you can call it bond yield. So how do you calculate bond yield? It's very simply the difference between the face value and the bond price, the purchase price, as a share of purchase price divided by time factor. This time factor is basically, since you know bonds are basically up to 1 year. What we are doing here is actually bonds in the sense bonds up to 1 year, right? We don't go beyond that in our syllabus. Bonds up to 1 year means that is actually bills, right? Treasury bills. You call them as zero coupon bills because we don't have any coupons for bills. Remember, we were talking about treasury bills here. I told you these are zero coupon securities, no coupons. So we do this calculation only for zero coupon bonds, which means treasury bills, which are normally up to 1 year or 365 days. Now, we can do this bond yield calculation even for longer bonds, but we don't do it here in our syllabus because it's beyond our discussion and it is a bit complicated than this, where you have to look at the coupon payments as well, which means the cash flows. So we don't consider that here. We are simply looking at the bond yield of a treasury bill. So keep that in mind. So treasury bill, so time factor means it's only up to 1 year. So if you take this time factor, if you divide this first part by time factor, you take it as a fraction. For example, if it is 3-month treasury bill, 91 divided by 365. If you use division here, but you can write this formula depending on your convenience as F minus P divided by P. Rather than dividing, you can multiply. So if you multiply, the T would be the other way around. 365 divided by 91. That is the only difference when you use this formula. It's very straightforward and easy. Okay. Now we have an example here. Let's say a face value of a zero coupon bond is 100. P is the price paid. So according to the example, the price paid is 98. The fraction of a year, the time factor is, how do you get? Since it is 3-month one, 91 divided by 365, if you were in the division, or if you are multiplying the other way around. So solving is very easy. 100 minus 98 divided by 98 divided by the time factor. So here the time factor is 0.25. Okay. So what you get is simply 8.8186, and you have to multiply it by 100 to get the percentage term. So I think it's very clear and straightforward. So here we have an example. An investor another example. An investor buys a 364-day treasury bill for 92 rupees and holds it till its maturity. Compute the annual yield rate for this treasury bill investment. So again, if you put up that formula, F minus P divided by P, then divided by the time factor, okay, and into 100. Now in this case, F minus F is, now F is not given, face value is not given. But if you are given the price of the bond, you can actually assume the face value. So if it is 92, it cannot be, face value cannot be 1000 or 10,000, right? So if it is 92, the face value, I mean, you can assume it should be 100. If it is 920, then you can assume face value could be 1000. So these are general conventions, 100,000, 10,000, because bonds are issued in that multiples, 100, 10,000, 10,000, etc. Okay. So you can assume face value as 100 here. Price is 92 divided by 92. So the difference here is 8. 8 divided by 92 into 100. In this case, this part becomes, I mean, 1, because you don't need to get a time factor because the question says it is 364-day treasury bill. So it's an annual or 1-year treasury bill. Now sometimes you might see 364 here, 365 here, but that doesn't matter because some countries have different conventions for this annual uh, uh, the duration of the bond. Some people say 1 year is 364. Some people say 1 year is 365. In different finance books, you have different methods used. Let's go to the next example. An investor buys 182-day treasury bill at a price of 96. The most appropriate current yield of this treasury bill is. So here I don't have any answer. Would you be able to calculate and let me know what would be the answer? Let me go to the chat box. See your answers. Just calculate and see. Answer is B. Some people say B. Suri says B. Dumali, she says B. How about others? Hmm? How about others? Are you doing it? Because this is a definite question in the exam paper. So I think most people say, Amansa, she also mentioned B. I think most people agree with answer B. As I said, it's very straightforward calculation. What you can do, simply the difference between face value and the bond price divided by bond price into time factor. So here the time factor is actually according to our formula. You, as I said, you can choose two methods. Here you can use time factor if you take dividing 182 divided by 360. So basically 0.5 into 100. So if you solve this, I think you get answer B. Correct. Now the second part, what is a zero coupon bond? I already mentioned to you, zero coupon bond is a treasury bill. In a zero coupon bond, you don't have coupon payments in certain time periods. 3 months, 6 months, annually, you don't get any coupons until the maturity. It's only a kind of a one-time payment of this zero coupon bond. So the best example for the zero coupon bond is a treasury bill. Then let's go to another type of instruments used in the bond market, repurchase agreements. Sometimes we call them as, in short, repurchases as repo. I think you may have heard this term repos. Repos are very common in money markets. The repo is simply, the simple idea of repo is exchanging. What are you exchanging? You are basically exchanging money and securities. So in a repo agreement, what happens is you are selling securities, which means government securities, for cash, for money, at a specified price with a commitment to repurchase the same securities at a fixed price on a specified future date. Say it again, you are basically agreeing to buy certain amount of securities or sell certain amount of securities at a given price on a particular date, and with an agreement to buy or sell it back in the future at a different price. So the profit of the repo is the difference between the selling price and the repurchase price. That is actually the interest income. If you are selling at a particular price today and buying it tomorrow at a particular price, the price difference indicates the interest income because you are based on securities, government securities. So we call these as actually collateralized loans. Collateralized loans means you are getting cash or you are giving cash against the collateral. Collateral means a security. What is this collateral? Government securities. So most of these repos are actually short-term money market instruments, which means people are using using these repo securities or repo instruments for money market activity. Money market means short-term market. You borrow overnight for 7 days, 3 months, or up to 1 year. This short-term market. So repos are a very popular short-term instruments to fulfill emergency cash needs. Emergency cash needs you can fulfill using the repos. Now in Sri Lanka, in the repo market, the banks and primary dealers, they are fulfilling their short-term funding needs by way of borrowing money or selling money in the sense giving loans based on the government securities. Okay. So in this illustration, I think it's very clear, a repo transaction. Let's say I'm a seller, right? I'm a seller in the sense, let's say I'm bank A. I need money today. Okay. I need money, but I don't have money. I have only securities. So let's say I have government securities as the bank A. I'm giving these government securities as a collateral to bank B. That is the lender of money. So I give him securities, he gives me cash. This is today, right? So I fulfill my requirement, and tomorrow, this is an overnight repo. Tomorrow, I need to settle the transaction. So on T+1, I'm going to settle it. So I'm bank A. What I will do now, I'm giving back the cash with interest, okay, to bank B. So bank A is getting an interest for his loan on the following day, and he is returning my securities back. So I'm getting my securities, giving back the cash. So this is a typical repo transaction. Now sometimes you may have heard the term repo, reverse repo. Now reverse repo is the opposite of this transaction. Now for example, for bank A, this is a repo. But for bank B, it is a reverse repo. Why? He is basically getting securities, giving away funds. So we call it repo since bank A has originated it because he had shortage of money. If this was originated by bank B because he has a surplus money, then you may call it a reverse repo transaction. So the same transaction, it's like two sides of the same coin, repo, reverse repo. But simple idea is you are exchanging money with securities for short-term funding needs. So these repurchase agreements are, I think, in most markets, they are happening based on the government securities. That's why we discuss that under government debt instruments bonds. Then let's move to private debt instruments. Private bonds. There are two types of private bonds. One is okay. Before that, the private bonds, we simply define them as corporate bonds. We use the term corporate bond. So this is a kind of an extraction for a corporate bond of US economy. If you look at it, it's written on the surface of the bond as corporate. If it is a government bond, you might see it as a treasury bond or a government bond or federal government bond likewise. If you see the term corporate, that indicates a private bond. So private bonds are actually the medium to long-term bond securities, debt securities issued by private sector companies. These are actually large, well-established companies. Usually, a small company doesn't issue corporate bonds. The well-established large companies, corporates, they issue these corporate bonds. So in a corporate bond, let's say the bank A needs some money and it can issue a corporate bond to the investors. Sorry. So the bank A issues a corporate bond to the investor. So as the issuer, I am obliged or I am committed to pay interest for this corporate bond and the principal when it matures. Let's say I'm issuing a 2-year bond. So at the 2-year period for this investor, I need to pay the interest and principal. Now sometimes you might have to pay coupons as well. In between there would be coupons. So it's very similar to a government treasury bond. Only thing is it is issued by private parties. So what are the features of these corporate bonds? It has a principal. Principal means the maturity value. Let's say 1,000. So issue a 1,000 value corporate bond, which means the principal. Simply that is the amount you borrow by issuing this bond. It has a maturity. Maturity means the period. 2 years, 3 years, 4 years, like that. Interest rates are there. Interest rate means basically a coupon is there and also yield is there. Both are there. Call and redemption features means sometimes these corporate bonds you can recall. You can early mature. Those facilities are there. And also protective covenants means some kind of principles, some kind of guidelines, rules attached to this bond to protect the investors. For example, the protective covenant could be in this bond. Okay, it says you cannot issue any more bonds to other parties again, likewise, because if the company issues more and more bonds, it could be in trouble when it wants to pay back. So the investors could have a covenant. Covenant means a protection, a rule saying, okay, you cannot issue more bonds, likewise. So these are some rules for the benefit of the investors. And as I said, there are two types of corporate bonds, debentures and commercial papers. Debentures are the most famous, popular corporate bonds. Sometimes you call them as corporate debentures. Okay? Private debentures. In Sinhala, you call them as Nayakar, right? Nayakar. So these debentures, as we already know, private bonds, normally issued for medium to long-term period with an interest, right? We know from our features there should be an interest, and also they are issued by private sector companies, as we already mentioned, could be banks, other financial institutions, large, well-established institutions. And as I said, there could be coupon payments of these debentures in between, 3-month coupon, 6-month coupon, likewise. So holders of the debentures, they are basically investors. They considered as creditors because they are giving a loan to the issuer. They are giving a loan to the issuers. One good feature of a debenture is considered as debt. So these are debt instruments. So in a private company, if there is a failure, bankruptcy, you have to liquidate it. Liquidate means you dissolve the company. Aberrakan. So when you dissolve it, you have to pay for the eligible creditors. Right? First, you have to pay these debt holders when you liquidate a company. So even before the shareholders, you have to pay for your uh, creditors, which means people who have given you loans. Debt has to be settled first. So that is a good feature of a debenture. In advanced markets, these debentures are very popular. But in emerging markets, they are becoming popular. They are there. But in countries like us, we have a very small debenture market. In a particular year, only 4 or 5 companies issue debentures. Whereas you see treasury bill bond market is amounting to more than 7 trillion, 8 trillion rupees. This market is very small. It's only, I think, 100 million, 200 million, maximum 1 billion market. Small. The other type of corporate bond is commercial papers. These are short-term, non-collateralized debt securities. So we consider them as non-collateralized short-term instruments. But these are very liquid instruments because private companies, they can use it for raise short-term money, and also for urgent funding needs. Normally issued by large companies, especially high credit-worthy companies having some large presence in the financial or in their markets, issued in large denominations, and these are issued actually at a discount. Discount means, let's say you are issuing 100 commercial papers. This is the face value. You may issue it at 90. So for the investor, the 10 difference 10 is the income of these commercial papers. So in that sense, these commercial papers are similar to treasury bills, isn't it? If they are short term, issued at a discount. However, some commercial papers might have interest component as well. In some cases, you would see interest component, which means interest are also paid on commercial papers. If it is, I think, long term, maybe more than 1 year, then you will see some interest is also paid. Then shares. So we were talking about uh, bonds, bond market, debt market, and equity market, right? So in the equity market, I think here there's a mistake. It should not be debt. It should be equity. Please correct that mistake, right? These are not debt instruments. Now shares are securities that represent some kind of a portion of the ownership of a company. So when you have that security representing the ownership of the company, you have some right to claim on the company's earnings and assets, right? Earnings and assets. The reason is, as a shareholder, uh, give me a minute. as a shareholder, you have the right to claim for earnings and assets of the company because you are kind of an owner. Even if you have one share of a company, you are considered as an owner. So shareholders can have the right for the net income and assets of this company. Net income means actually the profit. So the profit is distributed among shareholders as dividends. So shareholders get dividends. So dividends are like in a bond, you have coupons. So these coupons are considered as cash flows. So in a share, the coupons you get is actually the dividends. You cannot call it as a coupon, but a dividend is like a kind of a cash flow that you get time to time. But the difference is the coupon is a regular flow. Every 3 months you get a coupon income. But a dividend is not a regular thing. Companies do not pay dividends every quarter, every year. It's their decision based on the profit. If they have a good year, if they have make a reasonable profit, then they will declare dividends or distribute dividends. Otherwise, they will not. The, the board of directors will decide. So dividends are there, but it's not a regular flow. In the shares, these shareholders are considered as residual claimants. Residual claimants means in a situation of bankruptcy, they will get the residual, what is remaining. I told you first, the bondholders will get money. If you have debt, you have to pay for them first. After you settle their obligations, if you have any remaining or a residual component, that will be owned by the shareholders because they are owners, right? And in shares, when you have share instruments, you have voting rights to influence the management at AGMs, at special GMs, which means special general meetings, etc. So you are having some influence on the company. If you have a majority of shares, you call him as a major shareholder. If you have only few, you are a minority shareholder. So depending on the size of the share percentage you have, your ability to influence the company, the management would be changing, but you have this right to influence. Okay, and I have added this blue colored shaded area box because in particular papers I have seen some different classifications of shares. Now usually when you call it share, we know it's a kind of a ownership uh, instrument, but there are some cases this share instrument can have different features. So one is ordinary shares. So in an ordinary share, you don't have special rights or restrictions. You are entitled to have voting rights, but when the company is liquidated, you will be the last to pay. Now, these are the most common shares. If you go to the share market and buy, I think what you buy is ordinary shares. When you say the share market, you normally talk about ordinary shares. Okay? Non-voting ordinary shares means these are similar to ordinary shares, but you don't have any voting rights in a company matter, in an SGM. SGM means special general meeting, or an AGM, annual general meeting, you don't have rights to vote. It's simply a kind of a financial instrument without any voting right. The next important one is the preference shares. So in preference shares, you have a preferential treatment when the annual dividends are distributed. So what is the preference? When the annual shares are distributed, you are getting a fixed dividend. A fixed dividend is like a cash flow of a coupon, remember in a bond. So the dividend is fixed, but you don't have any voting rights when you have preference shares. So sometimes people call these preference shares as a hybrid instrument. Why it is hybrid? It's like a bond and a share. Why it has mix of features of bonds and shares? Because it's like a bond because you get a fixed dividend, regular cash flow. It is a share, like a share, because you get dividends. Right? So these are also very popular in share market. Then we have cumulative shares, preference shares, where you have the right to take your dividends to the future. So holders are having the right to carry out the dividends for the future years. Cumulative means you have accumulating dividend income. Okay. Next important one, redeemable shares, which means you can buy back them at a future date. Normally shares are issued at a kind of a without date. No, these shares are considered as perpetual instruments. The perpetuity. Perpetuity means no maturity date. Shares are not issued for 5 years, 10 years, likewise. No maturity, but bonds are issued for a period. 1 year, 2 year, 10 year, 30 year, likewise. But for shares you don't have. So you call it as a perpetuity. So these perpetual bonds, companies can have right to purchase before a particular purchase at a particular date. So at the issuance they will say these are redeemable shares. Redeemable means the company has the right to buy back these shares in a future date. So I circled couple of bonds, types of bond, three. So these are the most important type of shares that we can observe in the share market. Then let's look at what are the income streams of a share. As we already know, shares are having dividends. These are in advanced countries, you may call it some periodical payments paid for stockholders. For example, every quarter you might get a dividend, but there's no guarantee. Right? Company might decide, okay, every quarter we will pay a dividend, or every year we will pay a dividend, but there's no guarantee. That is the most important thing. So these are not regular. Not regular. So this is cash flows. Dividends means cash flows. The other one is the capital gain. Capital gain means the price difference. What is the price at the purchase? What is the price at the sale? Right? So you can call it as the price difference. Price at time t and price at time t minus 1, the previous period. So this is the purchase price. This is the selling price. That difference is actually the capital gain. So the capital gain or capital, even a loss could be there because the selling price, if it is lower than the purchase price, there could be a capital loss. So either case could be happen. Right? So as a result, the total income stream of a share can be stated as cash flows plus capital gain. So the cash flows are the dividends. Capital gain is the price difference. Okay. Now, in share market, in shares, the prices are really important because the share price is the key indicator of the performance of the share market. These share market prices are, share prices are determined through supply and demand for the shares, for these securities. So if investors see a company has a long-term potential, long-term potential means in the long term, the company is going to do better, making profits, going to have a big market. So overall, the company would be having a good time in the future. If investors think like that, they are demanding purchasing of such shares. So that will cause an increase in the share price. If a company is having a poor outlook, which means the company is not doing well in the future, the company is going to, make losses. No big market. Even the available existing market is going to shrink. Likewise, if investors see, okay, this company does not have a good prospect, then they are not demanding such shares. Even they are selling those shares. So that will lead to a decline in the prices. So by looking at the continuous increase or decrease in the prices overall market, we can name share market as a bull market or a bear market. So in a bull market, what you will see, share prices are continuously increasing. Right? So if you look at this picture in a bull market, the share prices are continuously increasing. So these are terms used in the finance literature, in finance media. Bullish market means the market is booming. Prices are going continuously up. The other side of the bull market is the bear market, where prices are basically going down, continuously going down. So some stock markets, their symbol is used like they use these symbols as their marks, trademarks. For example, I remember the Deutsche, the German stock market. Their key symbol is this bull, which means a kind of a growing market. So why this bull market and bear market are important for the investors? In a bull market, investors would like to buy because investors see prices are going up. So when the prices are going up, investors are starting to buy. And when the prices are going down, investors would sell because they think the prices would continue to go down and they might make losses. So the principle in the share market is buy low, sell high. So when the market starts buying, you starts picking up, you buy. When the market starts going down, you sell, right? So you buy low, sell high. That is the principle of the share market. That's how you make capital gains of this share market using the share prices. Okay. Then similar to the share market, we uh, uh, we can understand or identify a unit trust market is also there. I think we talk about this market in detailed manner in the markets, the mutual fund market. I hope you remember the same thing here. This is actually we are looking from the perspective of the instrument. Earlier we were talking about the market. Now we are looking at the instrument. So in the unit trust market or the mutual funds market, the instrument used is the unit trust. So it's a collective investment. I think we already know, where you have large number of investors pool their money in small quantities, maybe in small quantities, to create a larger investment fund. So when this large investment fund is created, that large fund is invested in many markets. Could be in securities market, could be in share market, could be in real estate market. And the investors are having a small units out of this investment. So based on these units, the investors are getting income, dividends. Investors are getting cash income. So when investors want to sell their units, they can sell like shares. So these unit trusts are managed by fund managers, asset managers on behalf of these investors. Right? I think we already have some idea about this. Venture capital market also we discuss, I think, in these markets. I remember I was talking about angel investors, right? Angel investors means who are helping for newcomers, putting seed capital. So the venture capital is also an instrument used to provide this seed capital, which means early money capital for the growing companies. When venture capital is provided for these companies, they are like, buying shares of these small companies or new companies. They are helping to grow by putting capital. And why it is important, I think we already discussed this thing. These small companies, early comers or newcomers, they don't have access to large or formal capital markets. They can't go to the share market. So instead, they can have venture capital from the angel investors as startup capital for their activities. Okay? So this is one form of providing share capital to the companies who are not listed. Right? This is also equity market participation in a different method. And there are some types of financial accommodations. We call them as financial accommodation. Probably you may have heard the term loans and accommodations. Loans are very clear. Loans are very clear means you give a principal amount, you charge interest, you have to service the loan, repay, that's it. Accommodation is a bit different. Accommodation is not exactly a loan, but it has features of loans. So the most common financial accommodations are leasing and hire purchase. Leasing and hire purchases. So I think these are very common instruments in Sri Lanka, uh, financial leases and hire purchases. So what do you mean by a lease? In a lease, you are providing financial accommodation to finance the purchase of a capital or a durable equipment. Leases are usually provided for capital or durable investment equipments. For vehicles, you provide some leasing. For buildings, you can provide leasing facility. For large machinery, you can provide leasing facilities. For lands, spaces, you can provide leasing facilities. So basically, that is helping the production process through this leasing. Now, in a lease, there are some interesting features. In a lease, let's say you have the asset. Let's say you have a vehicle as the asset, right? So this asset is owned by the company who is providing the facility. You call him as the legal owner or lessor. So the company is the lessor or the legal owner. What he does is he's basically lending this instrument to a person or another company who's prepared to pay the principal and interest cost of this equipment. You call him as lessee, right? So the lessor is, as the legal owner, lends, the word lends is very important, lends this equipment to the lessee to use this equipment over an agreed period of time. So during this period, the lessee, which means who has taken the facility, is entitled to have all the benefits of this equipment and also incur the cost. Benefit in the sense you are using this machine or a vehicle. Cost means every running cost and maintenance, repair, everything you have to bear. Okay. So during a certain period of time, let's say a 5-year lease, within this 5-year lease period, you are paying this principal and interest as lease rentals. Right? You are paying this as a lease rental over this agreed period. So after this 5-year period, the ownership is transferred to the lessee. After 5-year period, the ownership is transferred to the lessee. So up to that period, the legal owner, which means the lessor, the company, reserves the ownership. You call it absolute ownership. So in a lease agreement, the absolute ownership is an important word because the person who's providing the accommodation has the right or has the ownership of the asset. So that's why, for example, when you have a car lease, you don't have the original book of this car. You have only a certified photocopy. The book is with the company, leasing company, because they have the ownership. They keep the ownership with them. So once you have settled all your dues, after the agreed period, you get the ownership transferred under your name. So this is very important way of providing facilities to financial customers, consumers, in order to obtain an asset, purchase an asset under a installment plan. So these lease rentals are like installment. Okay? So these are very common in our markets. Then there's another type of financial accommodation, hire purchases. This is also an installment plan where the hirer, in this case you have a hirer, right, agrees to pay the cost of the equipment in different installments over a period of time. So the same way, it's very similar to a financial lease, but the terms and the working of the agreement is different, but the outcome is the same. So in some countries, you call these facilities as rent to own. Rent to own, what are you doing basically during this, let's say, a 5-year hire purchase? In this 5-year period, you are renting this machinery. I think hire purchases are mainly available for large machineries in most of the cases, right? So after 5-year period, you have the option to own it, or you can say, I don't want it. In this case, after agreed period, the ownership is transferred to you. But in this case, in a hire purchase, you don't have to own it at the end. But some interesting thing is happening. What is the interesting thing happening? When you hire it, you have the possession of that asset. Okay? In a lease agreement, when you take the lease, still the ownership is with the company. But in a hire purchase, when you hire it, you get the ownership, kind of a possession, into your possession. But after the period of, the hire purchase period, you have the option to give it back without fully owning under your name. So in Sri Lanka, we also had a hire purchase market. Now I think these two markets are working together actually, lease or hire purchase. That depends on the tax treatments. So any tax treatment can make a difference in this market. So sometimes back in Sri Lanka, we had a large hire purchase market, but there were some tax changes. So then again, what happens? The hire purchase market became very small, thin. Lease market became very big. Okay, so all in all, these are accommodations to acquire or utilize some of the assets. So I'm reaching the last part of this discussion. Before that, let me see if you have any questions in your mind. For auto loans, also the ownership is under F5, under the settlements. Auto loan means what happens? You basically, auto loan means you take a motor car using a financial facility, no? What happens there? You mortgage that instrument with the financial institution, isn't it? You buy it, but under your name, but you mortgage it. It's like buying house. You buy a house, home loan, it's under your name, but it is mortgage with the bank. So auto loan is also like that. Lease is different. In the case of the lease, the company has the ownership. It's not a mortgage. Right. Let me move to the next part, derivatives. Financial derivatives are very important instruments used for minimize the risk. We know in finance, financial markets, there is always risk associated with the transactions. So the financial markets are, or players are trying to minimize this risk or have a protection against this risk. To have this protection, markets are relying on financial derivatives. So these are contracts entered between parties for the delivery of an asset or to exchange of an asset in a future date or at a agreed price. So very simply, it's a kind of a contract. In this contract, what you have is a kind of an agreement that you will buy or sell a particular financial instrument in a future date at a future price, and you agree today. So in that sense, the financial derivative is based on a financial instrument, right? So it's a kind of a based on a financial asset. A derivative based on a currency is linked to currency. A derivative based on interest rate linked to a loan. A derivative linked to an option based on an option linked to a stock, share, a bond. Likewise, financial derivatives are relying on an underlying asset. So I mentioned you a couple of things here. One thing I mentioned to you as a contract. Contract between parties to exchange money in a future day at an agreed price, very simply. It is based on an underlying asset. That's the second thing I mentioned. Third thing I mentioned, use it for risk mitigation as a hedging or a protection. And also financial derivatives are traded in markets. You can trade it like a share, like a bond, you can trade. So let's look at a couple of, now this derivatives is a very complicated subject. Deep discussion is needed. In most of the courses, you have a separate module for derivatives, separate course unit. But in our case, we are simply looking at what are these derivatives. Very simple understanding is needed. Okay, so that is the purpose of this discussion. So financial derivatives, there are various types of derivatives. The most common and popular and the most simple type of derivatives can be divided as forward contracts and futures contracts. So by name, a forward contract indicates in an agreement to buy or sell an asset on a future date at a certain price. So you are here today, 2021. You agree to buy an asset or sell an asset in 2022 at a certain price, and that price is agreed today. Okay. So in 2022, let's say you are buying oil in 2022. Oil, you agree you will buy 100 barrels of oil in 2022 at $60 per barrel. That $60 you agree today, right? So in 2022, if the oil price is 65 market price, still you purchase at 60. So which means you have reduced your risk of price increases. It could be other way around also. Let's say this becomes 55. Still you need to do the transaction at 60. I think this is what has happened in the hedging transaction related to Sri Lanka, the famous oil case, right? The price has dropped. So let's forget that part. The forward contract is basically an agreement to buy or sell an asset at a future date at a certain price. These are traded in the over-the-counter market. Over-the-counter market means this is informal market. Informal in the sense, not the regular stock exchange and all that. I hope you remember over-the-counter market is based on the the telecommunication mode through the phones, internet, and other messaging techniques. You run this market, a large market, worldwide market. In this market, the forward contracts are very popular. And I remember I told you the most common market for over the counter is the significant market for the over the counter is foreign exchange market. Foreign exchange transactions are happening over the phone through dealers mostly. You have to take decisions then and there. You cannot have auctions or whatever, right? So similarly, the forward contracts are very popular in the foreign exchange market. Remember we talk about the forward exchange rate, forward price. So that indicates the forward contracts. Okay. So why people enter into these forward contracts in foreign exchange market? To hedge against the foreign exchange risk. A very good example would be a person wants to import a vehicle from Japan, can enter into a forward contract. Why it is important? Now, when he orders a vehicle, when it reaches the Sri Lankan port, it might take 6 months. So within this 6 months, the Japanese yen can fluctuate. So as a result, you might have to pay more money in rupees. To minimize that, you can agree into a forward contract today saying, okay, in 6 months time, I will be buying Japanese yen at this particular exchange rate agreed today. So even if the exchange rate goes up for yen in 6 months, still you will be able to purchase at the same price today. So some people do that, forward contracts when they are entering into LCs for vehicles. So this is the most simple way of derivative. Futures contracts is the same as forward contracts, where you have agreement to buy or sell an asset at a future date at a certain price, but they are not traded in over the counter, they are traded on exchanges. So futures market is much organized, standardized, where you have certain features of these contracts given in a standardized form. So these standardized products are used by financial markets as futures contracts in order to minimize their losses or risk. Similarly, even that oil example I mentioned, it can be done through a futures contract. in some countries there are futures markets for this oil. I think in US, in Singapore, there are large futures markets for oil. So in the futures markets, people enter into futures contracts to buy and sell oil at great prices today. But in our case in Sri Lanka, I think the forward contracts are the most popular in our markets, given its nature related to the over-the-counter market and mainly based on the foreign exchange transactions. Then another type of financial derivatives are the options. So these options are traded on both over-the-counter market and the exchanges. In an option, the buyer has, or the holder of the asset has the option to sell or buy an asset in a particular date, certain date, at a certain price. So he has the option to sell or buy an asset. So as a result, options are categorized as call options and put options. In a call option, the holder of the asset has the right to buy the asset by a certain day at a certain price. In a put option, he has the right to sell the asset in a certain date at a certain price. Why this option is given to the holder? In order to minimize the risk faced by him based on this financial transaction. So this financial instrument can be anything: a commodity, a currency, a security, or any other financial instrument can be used in these option contracts, option transactions as the underlying asset. So there are some important terms used in these option exercises. The most important term used in this option exercise is the exercise price or the strike price. What do you mean by exercise price or strike price? That is the price used in this contract. So I told you there's a call option or put option to buy or sell at a certain price. That selling or buying price is called as the exercise price or the strike price, right? So these are used in some markets to minimize the risk of price variation. Even for foreign exchange, you can have these options. Even for, as I said, another securities, you can have options. Okay. And then related to options, there is another type of financial derivatives, warrants. Now, I actually do not discuss these warrants in many cases because they are very similar to options. But in one of the papers, past papers, you had this question, warrants. So it is also a derivative that has the right to the holder to buy or sell. So by looking at the definition, it's very similar to the option. Even in an option, when you say the buyer, the holder has the option, it indicates he has some right. Here also, it is some right. So he has the right to buy or sell a particular financial asset in a particular price. But what is the key difference between option and a warrant? That difference coming from the origination and the maturity. Usually, options are short term, but warrants are long term. Usually, options are on the exchanges, but warrants are issued company by itself. Clear? By looking at the nature of the product, both are very similar, options and warrants, where the holder has some option to buy or sell a particular financial asset. Now, as a result, even you can call put warrants and call warrants. Call warrants means you buy, put warrants means you sell, right? So, in that sense, I think very similar to options. The only difference is coming from the origination, whether it is on an exchange or issued by the company itself, or for which period. As I said, options are short term, warrants are basically long term. Options are issued mainly on the the exchanges, which means very standardized. Warrants are issued by companies. I think only that difference, idea of that difference would be enough. But other than that, they have very similar features. Then the third type of financial derivatives are the swaps. Now, the swaps are also a derivative. What happens here is these are kind of financial contracts entered for the purpose of covering risk by having two different contracts in opposite directions based on an underlying asset. Say it again. Here you enter into a financial contract to cover the risk by having a contract in two opposite directions based on a financial asset. So what happens there is you are basically exchanging two products. So exchange means a swap. What are you exchanging here? So based on that, you can have two types of swaps. These are the most common swaps in financial markets. First one is a currency swap. Okay. Currency swap means based on foreign currency. So what happens in a currency swap? You enter into an agreement to exchange principal amount of a loan or an interest or both in one currency for the principal and currency in another currency. Now I'll tell you a simple example for a currency swap. Now let's say we have bank A, we have bank B, we have bank C. So bank A is a local bank, bank C is a local bank, bank C, let's say central bank, right? Bank B is a foreign bank. So in a currency swap, what happens? Bank A is getting, let's say, a loan from bank B, a dollar loan, right? Now, when the bank keeps this dollar with bank A, there could be exchange losses. Why? Because of the variation of the currency, there could be exchange losses. When the bank A is paying back to bank B, it might have to pay more because of the exchange loss. So to avoid that, what the bank A can do, the bank A is swapping this currency with the central bank. So it gives currency to the central bank and getting a rupee value for that. And on the maturity of this swap, the bank A is giving rupees back to the central bank and getting their dollars at that agreed price. Okay. So through this transaction, what the bank A is doing, they are minimizing their currency loss, hedging. So swapping means, currency swap means exchanging two types of currency here, isn't it? Here you are exchanging dollars as well as rupees. I think rather than getting confusing too much, you can simply understand the currency swap is a contract to buy foreign exchange while having another opposite contract to sell the foreign exchange in the same quantity. Now, if you go further, you can analyze this further. I think when you return this money, you have to pay an extra, which means you call them as swap points. Likewise, swap maturity date. There are some other terminology as well. But at this stage, we are not going to deal with such details. We only need to have some key understanding what is a currency swap. That is enough. Okay. If you really need to have thorough understanding how a currency swap works, probably you may refer to the the, the book, the reference book, Survey of Financial System, by written by Mr. Samarasiri. There you have some additional details. But for our purpose, this is enough to have some key understanding about the swap. Then the interest swap. Similarly, in a currency swap, now you exchange interest rates in this case. So here you exchange based on the interest value. Now again, you can have a similar example. You have A, B, C, right? Let's say these are three banks. So bank A is getting a loan at a fixed interest rate. So when he has a fixed interest rate, he faces a risk. Why? When he repays, even if market interest rates have gone down or gone up, he has to pay a fixed interest. So to minimize it, he can enter into another contract with another party to have a variable interest rate. So with that variable interest rate, you are paying less or high depending on the interest rate. So that is used to minimize the risk of your fixed rate. So these type of transactions we call as interest rate swaps. So we can say interest rate swaps are used to mitigate the risk of interest rate changes in the future. What we are doing here is we are exchanging a fixed interest rate with a floating interest rate or vice versa in order to reduce the exposure to interest rate in the future. I think if you have that understanding, that's enough at this stage, how to define a swap and what type of swaps are available. And during global financial crisis, from this point onwards, I am just giving you some idea about some derivative instruments used by international markets, especially after this global financial crisis. We have seen these markets. So one such thing is credit default swaps, CDS. These are very popular in European markets. What we are doing here is you enter into a swap transaction. Swap means, remember earlier we were telling you are exchanging the risk, right? So here you are exchanging the risk by way of a credit default swap in order to minimize the default of a credit. Now in this case, here we don't have any default. This is actually coming from market price changes, isn't it? The exchange rate, the interest rate change means market price change. We are not, we are based on that. But here, this is not coming from market price changes. It is coming from a default. Default means a person willfully doesn't pay. So in such situation, the CDS can help to mitigate the risk of a losing money. So it is a kind of a insurance for the investor. Now, if you look at this diagram, let's say this person is 123 firm. He is buying a bond of ABC firm. So this is the bond. So he buys a bond from ABC firm. Bond means what? Credit, a loan. So now this ABC firm is, let's say, a private firm. If it is a government, you don't have a risk. But if it is a private firm, you have some risk. What is the risk? The person, the company might not pay back. To reduce that risk, the 123 firm can go to bank 456 and ask for an insurance. So what is the insurance he asks? If this ABC firm defaults, please pay my bond value if the ABC firm defaults. So 456 bank is providing some insurance to 123 firm in the case of a default of this ABC firm. So what's happening here? You are having three parties to exchange the instrument. The ABC firm and 123 firm is having a bond agreement. The 123 firm and 456 bank is having an insurance agreement. For that, they charge a fee. So these are called as credit default swaps used in bond transactions, okay, which are not, available in the Sri Lankan context financial markets. And there is another type of derivatives that we have seen from the times of this crisis. You call them as structured financial instruments, structured finance. Structured finance means they are structured based on the idea of securitization. Based on this securitization, I'll come back to that securitization definition. Based on this securitization of assets, you can create different types of instruments, collateralized debt obligations, asset-backed securities. So by name, you can see collateralized. Asset-backed means there is an underlying financial instrument or structured financial instrument in this case. So you call them as structured finance. So what do you mean by securitization? Now, as I said, structured finance is based on the idea of securitization. Okay. Now let's say you have various projects. as a company, you have, let's say, various projects or let's say various assets. Now, if you, for example, let's say you have 3 loans, 1, 2, 3. These are bad loans. Bad loans means these are doubtful. People are not, you don't know whether they will pay or not, because you have seen some irregular repayments for these loans. So in securitization, these loans you can remove from your balance sheet. These loans are in your balance sheet, no? Every loan you have given, they are in your balance sheet. So in securitization process, you can remove these balance sheets loans from your balance sheet. You may call it bad loans, illiquid assets. If they are bonds, they can be illiquid assets. Not good, not so good. And by removing these 1, 2, 3 loans asset, you create a new portfolio. This new portfolio, under securitization language, you call it, okay, I'll come back to that point later. So you create a new portfolio. Let's say project 1 loan is 100, project 2 loan is 200, project 3 loan is 300. So by pooling all, you create a 600 portfolio. Then you convert such loans as new instruments. Maybe you can divide them into equal instruments, 120 each. You make it like a share. Right? Then each of these new instrument, let's say instrument A, B, C, D, likewise they are new instruments. These instruments are sold to new investors. Right? So based on a particular asset, you created a new instrument, that is the structured finance instrument. So this entire process, we call it as securitization. And for this purpose, companies are creating separate institutions. We call them as SPVs, special purpose vehicles. So in securitization language, a special purpose vehicle means a company or an entity created for removing bad assets from a particular balance sheet and creating new instruments using that bad assets. So these A, B, C, D, as I mentioned examples, can be in different forms. As I said, it could be asset-backed securities, collateralized debt instruments, which means using those bad assets. If it is a bond, you call it a asset-backed securities. If it is a loan, you may call it a collateralized debt instrument, which means these are collateralized instruments or backed instruments, structured instruments to use to minimize the risk of a losing by a particular through a particular asset. The idea is a bit complicated, I know, but here what you only need to understand is what do you mean by a structured financial product? So a structured financial product means simply based on a risk transferring to a particular special entity or a particular portfolio, you create new instruments based on that asset. So creation of that new instruments is done through the securitization process, as we have discussed in this slide. Through the securitization, you can create either asset-backed securities or collateralized debt instruments. Both are actually backed by these financial institutions, financial assets, in order to minimize the risk of default. Right? Last one, this is also a kind of a derivative, COCOs. I'm teaching this because this is also was in your exam paper. COCOs, contingent convertibles. So these are COCOs are actually hybrid capital securities. Hybrid capital securities means when you say hybrid, it has the feature of a share and also a bond. When these hybrid capital securities or COCOs are used to absorb losses when the capital of a bank is falling below a certain level. Let's say a bank should have capital of 500 to the example. This is the minimum capital they should need. Let's say in the crisis period, due to losses arising due to defaults and all that, this capital is falling to 200. So there is a shortage of capital of 300. Now this 300 during a crisis period, no one will help. Investors will not pump money. The government will not give money. So you are under threat of having enough capital. So in such case, such banks can rely on issuing a COCO, which means contingent convertible, to raise capital to bridge this capital gap. So as a result, what will happen? When this 300 is fulfilled, the bank is having enough capital and also they are reducing the risk of having debt. Otherwise, the bank should have to fulfill this 300 by borrowing. So having more borrowings, remember I told you earlier week, more debt means more risk. So here the bank is avoiding that risk, is having more debt by issuing these COCOs. So these are common, especially in the times of crisis. So people or the banks issue contingent convertible bonds in the crisis periods. So this is used for capital, I already mentioned. Also as a result, people call it as enhanced capital note. If you see the term enhanced capital note, the idea is basically the contingent convertible. So out of this discussion on derivatives, I really recommend you have some key idea about forward and futures contracts, their differences. What do you mean by option contract? And also mainly swaps. What do you mean by a currency swap? What do you mean by an interest rate swap? Because these are in your exam. Very occasionally in your exam papers, you find these things. Other things, this CDOs, securitization, I don't say it may not be in the exam, but we have seen hardly in certain occasions only, but I think you should have some idea. In the last section, I have given you some examples related to these financial securities, especially focusing on the Sri Lankan context. So in Sri Lanka, in the government securities market, the main instruments are actually treasury bills, treasury bonds, rupee loans, Sri Lanka development bonds, and international sovereign bonds. So I have given you some explanation about these different instruments their features and all that. But don't worry, in your exam, no one will ask these minor or granular details, right? For example, no one will ask what is the minimum amount of bid at a primary auction, or how the interest rate is determined. Those questions will not be in your exams, but you should know what type of instruments available in Sri Lanka and key features. So here I have given these instruments and their explanations. So treasury bills are short-term instruments that we have, and then treasury bonds are the long-term instruments that we have in Sri Lankan market. So our market is basically from, I think you might have some idea, the longest duration of a bond that we have issued is a 30-year bond, sometimes. So after that, more than that, we don't have. So the longest maturity is 30-year bond. So these are used by the government to finance their deficit, uh, budget deficit, by issuing into uh, domestic investors. And one important thing is in Sri Lanka, 5% of these instruments are uh, allocated to the foreigners. So foreign parties can also buy treasury bills and bonds amounting to 5%. Then we have rupee loans. Actually, I included this because there are some remaining balances of these rupee loans. Other than that, the central bank or the government now they don't issue these. Rupee loans are actually earlier we didn't have these treasury bonds. Treasury bonds we issued in 1997 actually. So before that, we issued rupee loans as long-term instruments, 2 to 30 years for Sri Lankan uh, investors. They are issued at like using coupons and all that. So it's like a treasury bond, but their interest is determined by the authority, basically artificially, administratively determined. And these are not traded in the secondary market. But here, treasury bonds, you have a secondary market. Treasury bills, you have a secondary market. So rupee loans, you don't have a secondary market. Then we have Sri Lanka Development Bond. Recently also, probably you may, if you have watched the financial news, you might see we are issuing these dollar denominated bonds. So these are US dollar bonds to raise dollars. So SLDBs, you call them as SLDBs in short. We issue SLDBs for Sri Lankans or banks who are having dollars with them. Who's having dollars mainly? Banks, right? Foreign citizens, they might have dollars. So we are targeting them and issuing these SLDBs to raise dollars. So mostly these are 2 to 3 year instruments issued by the Sri Lankan government. But basically, as I said, this is targeting kind of a domestic crowd. Foreign citizens, non-residents, Sri Lankan dual citizens, banks, they are, in a way, they are linked to the domestic economy. But we have instrument issued only for foreigners. What are they? International sovereign bonds, ISBs. So these ISBs are used by the government to raise foreign money by issuing in foreign countries. So remember, I used the term euro bonds. So the ISB is a euro bond. So non-resident investors are eligible to invest. These are traded in international stock bond exchanges like Singapore and London. Recently, I think last year, Sri Lankan government allowed even Sri Lankan banks to buy these. Earlier, banks were not allowed. But later on, government allowed banks to buy these things. But again, it was stopped or banned. Now they are not eligible. Okay? So this is helpful to raise foreign money. We raise these in large quantums. For example, $5 million, sorry, $500 million, $1,000 million. The biggest amount we have raised, I think, $2.5 billion as the sovereign. Then I have included some questions for you to, basically look at. See, as I said, you need to know some of these definitions of these instruments. Remember, I told you about these warrants, right? There was one question in one of the papers. Preference shares, remember, I told you. And also calculations, right? Based on these certain treasury bills, bonds. And also, I told you about the swaps, options. There are some questions related. So all in all, I really recommend you look at the past papers and also the marking schemes, because I don't think we will have enough time in going in near future to discuss these exam questions. But hopefully, in the revision class, I'll be talking or discussing some of these exam questions. Panda bonds, I think I discussed last week. Panda bonds, samurai bonds, sukuk bonds, different types of bonds. I think that part is also covered. Okay, now I think we can stop at this point. In the last session, I'm planning to talk about the last topic, which is financial regulation and crisis, to give you some understanding about the financial regulation mainly, because that is also one of the important component of the financial system. So we need to have some idea. So that would be the last session, hopefully next week. And then we will conclude, and you all are welcome to the revision sessions. There we will be mainly looking at the exam questions, answering exam questions without paying, big attention to the theory. We will do much of a exam questions in the revision class. Okay, can we stop at this point and let's meet next week? And I'll share one more, in addition to the materials for the next week, I'll be sharing some additional readings for you to look at the financial infrastructure, basically payment and settlement system, to have some understanding. Okay, shall we stop here?